Hi, this is Dan at Master Trader, and in this video we're going to define a short iron butterfly, or iron fly as many refer to it as. In our option strategy series, we split up the strategies into directional and income producing. Short iron fly is one of our income option strategies. A couple definitions before we get into the iron fly. An option is a contract allowing for the right to buy or sell the underlying during a specific time for a specific price. Call buyers pay money and have the right to buy. They're bullish. They want the stock to go up. Call sellers receive money and have the obligation to sell at the agreed strike price. They're bearish. They're taking the other side of the call buyers bet. Put buyers pay money and have the right to sell. They're bearish. They want the stock to go down. Put sellers take the opposite side of that. They receive money and have the obligation to buy at the agreed price, and they're bullish. You're going to see now that we're going to be using every one of these in the short iron fly. So we're selling calls and puts at the same strike and expiry. So that, if you go look at our other strategy, is a short straddle. That's a short straddle. But we're also and simultaneously buying out of the money calls and puts, as those are referred to as wings, to make this a defined risk trade and also less margin. You get a little bit less total credit, of course, because we're having to buy these two options, but the benefit here of defined risk and less margin is well worth it in our recommendation. Max gain on any option selling strategy is the money received. Max loss is the spread width less the premium you received. Break even, it's the short strike right in the middle, plus the credit and minus the credit. You can see our little boat here in a nice calm seas. That's when you use the iron fly strategy. We prefer overpriced options, but here's the calm waters. We're thinking that the stock will move less than the break-even points at expiration. So even though I'm saying calm waters, you could do this into earnings, so you are expecting a bigger move. However, the key point is the premium that you're receiving, the net credit has to be perceived to be greater than whatever you think the actual move is going to be. So let's take a look at our QQQ quote screen here to show you how you would put this trade on. Trading at 114.05. So 114 is our at the money strike. We have 15 days to expiration in this example. So we're going to do our short straddle, selling at the money call, at the money put, sell both here, it says there. Then we're buying an out of the money put for protection, out of the money call for protection. We load all four of these up into one order called a short iron fly in your software, and it'll calculate the midpoint for all four of these legs. Whatever the net credit is, that's what you're getting paid for the risk involved in this. So we just went over the break even and gain and loss, etc. And you're only going to lose on one side. So just wherever it ends up. And that is the short iron fly. Hope that helped, and see you at the next video.